Hey everyone, and welcome. Today, we're going to break down LIC's Bima Kavach plan. Using the official plan documents, we'll get right into what it is, how it actually works, and some of the really big choices you'll need to make. So, let's get started.
But before we jump into all the nitty-gritty details, let me ask you something. Are you just looking for a simple, no-fuss financial safety net for your family? You know, a plan that's all about protection? If that's what you're after, then stick around, because this might be exactly what you're looking for.
All right, first things first. Section 1. What exactly is Bima Kavach? We're going to start with the absolute basics here, the core concept, so everyone's on the same page. Okay, so the single most important thing to get your head around from the get-go is this term, pure risk plan. What does that even mean? Well, think of it this way. You pay your premiums for a set amount of time. If, God forbid, you pass away during that time, your family gets a guaranteed payout. But if you live past the end of the policy, it just ends. There's no cash out, no investment return. Its one and only job is protection. That's it.
And this slide really helps cut through all that insurance jargon, you know? Non-linked just means your plan isn't tied to the roller coaster of the stock market, so it's stable. Non-participating means you're not getting a slice of the company's profits. It's an individual plan for one person, and like we just talked about, it's pure risk, 100% focused on that payout if the worst happens.
So who's this for? Well, the age range is pretty wide. You can get in on this as early as 18 all the way up to age 65. It's really designed to cover you for most of your working life.
And how much coverage are we talking about? Well, the minimum you can get is a pretty hefty 2 crore rupees. Now, technically there's no maximum limit, but, and this is a big but, anything higher than that minimum is going to go through the company's underwriting process. They'll need to assess the risk before they approve it.
Okay, moving on to Section 2. This is a big one, your 2 big choices. Right when you sign up for this policy, you have to make 2 key decisions that will literally define your entire coverage. Let's break them down.
So, your first major decision is this. Do you want your coverage to stay the same, or do you want it to grow? Option I is the simple one. The amount is locked in and never changes. But option 2, that one's pretty clever. It's built to fight inflation. For the first 5 years, it stays put. Then, it starts growing by 10% of the original amount every single year, until it literally doubles. This is perfect for someone who's thinking, hey, my family's needs are going to be bigger in 10 or 20 years.
And check this out. This table shows you exactly how that works in the real world. See that 2 crore policy? In year 6, boom, it's 2.2 crores. Year 7, 2.4 crores. And it just keeps on climbing until it maxes out at double the original, a massive 4 crores. It's like having inflation protection built right in.
Okay, listen out, because this is super important. The choice you make right at the beginning between option I and option 2 is set in stone. It's permanent. You can't change your mind later. So you really need to think about your long-term needs before you lock this one in. Your second big choice hits you right in the wallet. It's all about what you'll pay. You can actually get lower premiums with non-smoker rates, but you'll have to prove it with a medical test. If not, you'll be on the standard smoker rates. And trust me, this isn't a minor detail. The difference in cost over the life of the policy can be absolutely huge. So, you made your 2 big choices. Is that it? Is the plan locked in forever? Well, not exactly. In Section 3, we're going to look at how you can actually customize your coverage with some optional features as your life changes.
First off, you can bolt on something called a rider. The accident benefit rider is a great example. It's an extra layer of protection that provides an additional payout if death is caused by an accident. It's totally optional, but it's there if you want that extra peace of mind. Now, this next feature is seriously smart. It's called the life stage option. The policy actually gets that your life isn't static. Your responsibilities grow. So, it lets you increase your coverage at major life milestones. When you get married, you can bump it up. Have your first kid? Bump it up again. Second kid? You get another increase. It lets the policy grow right alongside your family. But of course, there are a few rules you gotta know. To even have this option, you have to sign up for it when you first buy the policy. You also have to be 40 or younger when you start. And here's the kicker. You've only got 6 months after the event, like your wedding day, to actually request the increase. And here's another bit of flexibility. You get to decide how your family receives the money. Should they get it all at once in a big lump sum? Or would it be better for them to get it as a steady, reliable income over 5, 10, or even 15 years? That choice is up to you. All right, we've gone through the main features and choices, but now we're heading into what might be the most important section of all,
understanding the fine print. These are the rules and scenarios you absolutely positively need to know about.
Let's start with a question I know is on a lot of people's minds. What happens if you miss a premium payment? I mean, life happens, right? So what are the rules?
Well, the good news is there's a bit of a safety net. For yearly or half-yearly payments, you get a 30-day grace period to pay up before the policy lapses. And even if it does lapse, you have a surprisingly long time to fix it, a full 5 years to revive the policy, as long as you meet certain conditions and, of course, pay what you owe.
Okay, another really important question. This isn't an investment plan. We know that. So what happens if you just decide to cancel it halfway through? Do you get any of your money back? This is where it gets a little tricky, because it all depends on how you've been paying. If you're on a regular premium plan paying year after year and you cancel, I'm sorry to say you get nothing back. But if you paid with a single or limited premium, meaning you paid a lot up front, then you might be able to get a partial refund. But there are specific conditions for that.
Now, every life insurance policy has clauses that cover really difficult situations, and it's important to be aware of them. The plan document is very clear. In the tragic event of suicide within the first 12 months of the policy, the nominee won't receive the full sum assured. Instead, they'll receive 80% of the premiums that have been paid up to that point.
And that really brings us full circle, back to the big question. We've seen what Bima Kavach is. It's a pure protection plan, straight up, but with some neat options for growth and flexibility. So the final thought I want to leave you with is this. Is a focused, pure risk plan like this one the right foundation for your family's financial future? Something to think about. Thanks so much for joining me for this explainer.